Welcome back to Yahoo Finance Live. The London Stock Exchange Group reported earnings from the first half of the year, noting a slight decline in listings, but CEO David Schwimmer is optimistic that a new wave of IPOs, initial public offerings, could be on the way. For more on that, let's bring in David, again, CEO of the London Stock Exchange Group. Great to have you on the program this morning, David. First of all, just kind of unpack what you've been seeing in capital markets. Obviously, public offerings and companies eager to tap the capital markets, a big part of your business. What did that look like over the first half of 2022, and what's your outlook for the remainder of the year?
So definitely a slower first half in terms of IPOs, given the market environment. Not particularly surprising given the volatility, given the war in Ukraine. But I must say, Brian, in terms of first the pipeline, that market will come back. The IPO market closes, it opens, that'll come back. And then in terms of our overall business, the London Stock Exchange, great part of our business, fantastic business, but less than 5% of our overall revenue. And we've seen great growth across all of our businesses with 7% top line growth and broad-based growth across our capital markets division where the London Stock Exchange itself exists. Our post-trade business, 9% plus 9% growth. And then in terms of our data and analytics division, 5% growth. So really across the board, pretty strong performance. I'm really pleased with that. Yeah,
as you mentioned, David, a lot of arms that you have over there at the London Stock Exchange Group. But I do want to just kind of focus still on the market side of things, just because you have such an interesting and unique vantage point from that front. I mean, when you say you do expect things to get a little bit better, I mean, we've already seen kind of a rebound so far this summer. But is there anything idiosyncratic to specifically Europe that you've seen as an interesting factor here when you consider you've seen the Bank of England's projections over a possible recession happening in that area, broad Eurozone projections showing similar slowdowns as well? How do you think that affects companies that, still want to do capital raising, but it's just such an uncertain environment right now?
Well, one of the things that is a bit different about Europe, particularly relative to the US, is the energy challenge. Europe is more exposed to what's going on in Russia and the gas dependency there. So we'll see how that plays out. I'm not in a position to predict, but that is a greater sensitivity relative to the US. In terms of some of the other aspects that we've seen in the overall environment, whether that's inflation, recession risk, some of the other challenges, you're seeing inflation in Europe, you're seeing inflation in the US, you're seeing recession risk in all the different markets. But I would say the energy exposure, the gas exposure in Europe is a little bit of a different one.
So let's switch over to data analytics. That's been a very interesting part of your business when we just track the evolution with the acquisition of Refinitiv. I believe that was about a year and a half ago or so. So you've seen revenues up about 5%. How important is that data business to what you're doing here? What do you see as the synergies between, a pre-Refinitiv acquisition, London Stock Exchange Group, and a post-acquisition?
Well, it's been a transformational acquisition for us. If you go back prior to our closing of the Refinitiv transaction, the London Stock Exchange Group, LSEG, was an important provider of execution venues, mainly in equities and largely with a European focus. Geographically, we largely had a European focus. And in terms of our data and analytics capability, we had the FTSE Russell business and we had some very attractive fixed income analytics capabilities. Today, we are one of the world's leading providers of financial market infrastructure and data on a global basis across asset classes. So instead of being primarily focused on equities, we now have leading execution venues in equities, foreign exchange, and fixed income, again, on a global basis. We have 25,000 people around the world. We have a presence in 70 countries. And that presence is in the Americas. We have several thousand people in the Americas. We have 10,000 plus people in Asia. And then as a data and analytics provider, we're one of the world's leading providers of financial data and analytics. We're the world's #1 provider of real-time data, leading provider of background check information for banks doing KYC and AML through our World Check database. So it's been a transformational transaction for us, really positioned us globally as one of the world's leading providers of, as I said, financial market infrastructure and data across asset classes, across the trade lifecycle.
All right, London Stock Exchange Group CEO David Schwimmer, thank you so much for joining us. Really appreciate it. A number of media companies reporting earnings last week, with meme stock AMC giving us a flavor of the movie industry. The big story for them, the issuance of dividends on new preferred shares called APE, of course. The company CEO Adam Aron telling Yahoo Finance earlier it's a counter to the haters who have called for a lower stock price. Take a listen.
There are securities analysts whose livelihoods depend on being accurate in forecasting stock prices, who've called for our share price to fall to a penny or $1 or $2. They don't want to see our stock go up. At the last count, there were 100 million short shares out there. I don't think they want to see our stock price go up. Now, that's different from people who are just skeptical.
One of those people that he might be referring to is LightShed Partners media and technology analyst Rich Greenfield, who joins us live alongside our media reporter, Ali Canal. Thanks so much for taking the time, Rich. You want to respond? You have a 1 penny price target on this stock.
You know, Adam does a great job of spinning reality, and it sort of is that, you know, P.T. Barnum, and he's sort of found followers who don't really understand what they're investing in. And I think that's really the scary part, because what these new APE shares essentially allow him to do is to dramatically dilute shareholders on a recurring basis. And he can issue billions of these new shares and dilute current shareholders down. And so while the market has reacted positively over just Adam saying it's a positive, the reality is this is a company that continues to really struggle. I mean, box office, for all of the excitement over the big movies that have come out and people saying the box office is back, let's just be clear. Box office is down 15% in Q3 from the average of 2016 to 2019's box office, so pre-pandemic levels. Year-to-date box office is down over 30%. The pipeline looks pretty dry over the course of the next couple of months. So this is a story where, yeah, consumers are going back to see a few movies. There's definitely big movies are performing. Mm-hmm. But as you saw this past weekend, if you're not one of those 3 or 4 movies are just getting destroyed financially. Yeah. And so this is really a have and have not, and the haves are very few and not enough to support Adam's business.
Well, I guess, you know, the other side of the coin, though, is that even if it dilutes shareholder value, it puts AMC in a better capital position, maybe to weather some of those secular trends. So does that still value a 1 cent valuation that you have on as far as a price target here? I mean, are movie theaters going to be dead at some point? Is that the call?
It's not about being dead. It's about you have 2 problems. You either have a substantial amount of debt weighing on this company financially, or you have to dilute the value of what a share is to something that is a small fraction of where you are today. There really isn't another solution. So no, they're not going away. There's far too many movie theaters in this country. You still have tens of thousands of movie theaters that you don't need nearly that many in a world of streaming. You need far fewer than where we are today. And so this is not a referendum on the movie theater industry. And I think that's a lot of what the retail holders of AMC have gotten wrong. This is not about whether AMC will continue to exist, but just pull up the valuation of Cinemark. Cinemark is at a small fraction of AMC's valuation. Same company, roughly same profitability, on an overall basis. And yet it is a small fraction of AMC's market cap enterprise value, which I just think speaks to the fact that there is this huge disconnect between reality and where AMC is trading today. And look, Adam knows it. The beauty of what Adam's done is he's literally gotten all of these investors to buy shares as he dumps his own personal shares. Every time he gets a new share, he dumps it into the market. So
Rich,
he's looking to personally benefit from this as much as possible.
So can I just ask, do you think it's healthy in a situation like this where you have CEOs, lobbing tweets out there about all this back and forth that includes you as well? Is this type of dialogue healthy in a capital markets where it's okay to have people on different sides of the trade, but I mean, this is a dialogue that I didn't expect to have this morning.
Look, Adam can say whatever he wants. I think he's very disingenuous with how he misleads shareholders. And at the same time, where he says, well, I'm not really selling, I'm just diversifying, even though he sells every share that he gets granted or vests in personally. So again, I think it's very disingenuous. I think it's, very dangerous for the public markets in terms of what he's doing as a CEO. But look, it's a free country. He's allowed to have his own view of what the shares are worth.
And Rich, what if we take a look at the broader picture, right? In that interview, Adam Aron predicted that ticket volume will, quote, probably be back to pre-pandemic levels by 2023 or 2024 at the latest. What's your take on that timeline, considering there has been a shift in consumer behaviors?
Look, the thing he doesn't talk about is that windowing is very different, right? And, now movies are coming out. Movies that are being released in theaters are coming to streaming services far sooner. There's a tremendous amount of easy to access content on these streaming services. It's just, I think there will always be a reason to go see a huge movie in a movie theater. I don't think that behavior is ever going away. But the bar to get you to leave your home and go see a theater is higher than it's ever been. And it's going higher and higher. I mean, look, just this weekend, John Lasseter of Pixar fame now works at Skydance Animation, which is part of, David Ellison's Skydance Productions. They have an exclusive distribution deal with Apple. And so you were able to see a Pixar-like animated movie at no incremental cost as part of your Apple TV subscription from the comfort of your own home this weekend. And so there's just big changes in how movies are being released. And it doesn't mean you're not going to go. It just means you're going to go less often and be more selective in terms of quality. And I think that is the huge change that we've seen, and that, Adam and the team at AMC just continue to not acknowledge.
And someone who is bullish on the theatrical experience is Warner Bros. Discovery CEO David Zaslav. And we heard from the earnings report that he's really leaning into the theatrical. He also had made it pretty obvious that he knows how to cut costs. But when the growth trajectory for a lot of these media companies is more muddled than years past, and there's a lot of experimentation with gaming, live events that tie in again to the box office, how should Zaslav approach this new WBD strategy and instill confidence that he also knows how to spend money in addition to cutting costs?
Well, look, there is no doubt that putting movies directly onto streaming is essentially betting on the future. It's a huge investment because you don't earn the return on putting a movie directly onto HBO Max in the same way that you have releasing it in the theaters, selling it on DVD or whatnot, and then putting it onto a streaming service. So I think what you're really seeing at Warner Brothers is for a company with, essentially 4.5 to 5 times leverage in very challenging environment for media companies. I mean, look, this is an entirely new territory for media companies where cable network revenues appear to be declining industry-wide. Everyone is taking evasive action and rethinking their strategy. And I think for Warner Brothers, are they embracing theaters because it's the right thing to do? Probably not. They're embracing movie theaters because financially it makes the most sense for them. And right now with their leverage, they need to be very focused on driving free cash flow and deleveraging. And I think that means to them embracing theaters and making sure they make as much money on every film versus the prior management team, which was taking sort of we're going to invest heavily in our HBO Max. It's going to be the kind of North Star of everything we do. They're moving away from that being the North Star. I actually think it's a pretty good buy signal for Netflix. Seeing HBO Max pull back should give investors a lot of confidence about Netflix over the course of the next 12 months.
And I also want to get your take on Disney. That company reports earnings after the bell on Wednesday. There's been a lot of talk about the future of ESPN Plus, where Disney could take that platform. Also a big question about their future guidance. Are they going to cut guidance based on the differences that have happened across the streaming landscape? What are you watching for in that earnings report?
I think we're really trying to figure out now. Bob Chapek, CEO of Disney, who took over for Bob Iger, he just got a new 3-year contract. I think everyone who owns or looks at Disney is now focused on who is Bob Chapek? What's the plan? He's got 3 years now, in terms of contract. What are we going to see? Is he going to keep ESPN and ABC? Is he going to transform what Disney looks like? I mean, video gaming, he's talked about the metaverse. Like, he seems to talk about sort of leaning Disney into the future. obviously the future is not broadcast TV and cable networks. So I think we're really trying to get a sense of what is the future of the Walt Disney Company look like? What's his strategy? Are they going to wait until 2024 to own the rest of Hulu? Do they try to do something sooner? Selling, buying? I mean, there's just so many big open questions. You brought it up with ESPN Plus. Why do we have 3 services? Disney Plus, Hulu, ESPN Plus. There's a lot of big strategic questions sitting in front of Bob Chapek. Hopefully we'll start to get a little bit of a glance at what those look like on Wednesday night.
Yeah, and broadly speaking, Rich, I mean, you talk about the challenges that a lot of these media heads have with, streaming revenue not being, it's still very costly right now, with regular legacy revenues also declining. You have a good blog on your site about that. But Rich Greenfield, partner and media and tech analyst at LightShed Partners, thanks so much for joining us. And our thanks to Ali Canal for joining the conversation as well. Appreciate it.
Well, a shortage of teachers across the country continue to cause concerns ahead of the new school year. An American Federation of Teachers task force recently issued recommendations for the country to attract and retain talent. Joining us to discuss is AFT President Randi Weingarten. Randi, always good to have you on the show. We have heard stories from all over the country about the shortage of teachers, what that means for back to school, and really a network being created so teachers can alert each other to those who are moving so that they know right away when another teacher is coming in. I mean, talk to me about what this means for planning for the upcoming school year and how this affects it.
Well, you have a perfect storm going on right now. And we have been warning about this for a long time. It's, that's why we had this big teacher shortage report that we adopted this summer, chock full of ways of how to solve. But what you have is, you have higher number of retirements this year, which everyone predicted because it was a really, really hard year. You have fewer people going into the profession. You have a hot labor market where teachers can get 20% more for the skills and knowledge they have teaching in non-teaching jobs. You have all of the pandemic stress and strain, particularly that kids are coming in with greater needs because of 2 years of disruption. And, the condition, not only have the conditions not really changed, but, school districts and the federal government and others just, pretend as if there was no pandemic. And then you have all of the politics, the culture wars, the shaming and blaming, the banning of books, the censoring of curriculum. Mm-hmm. So, teachers are, they wonder. I mean, I'll give you an example. So many teachers said to me, if a kid asked them a question after the Buffalo mass shooting, if they were in Florida or Texas, they didn't know whether they could answer the question that the shooter was a white supremacist because of the new rules that had passed. So you add all of that together and you have a perfect storm. It was foreseeable and it is fixable, but we have to actually have the will to fix it.
Yeah, Randi, it's Brian Chung here. When we look at the data, especially on the local level of employed teachers, you see the massive shortfall that has not had the recovery that the overall labor market has had. We are still very, very short of where we were pre-pandemic because of the factors that you outlined. Now, you talk about salaries and benefits, and when we look at local government specifically, municipal budgets are a big part of this. So how do you think they factor into this? Because even my mom, she works at a small school in a local town, and she's been saying, look, there are people who are leaving. They're asking her to double up on roles, doing lunch duty in addition to doing the teaching.
Right.
But it's not a simple solution, right?
Well, it's not a simple solution, but it is. There are obvious remedies, some of which don't cost a dime, and some of which cost money, which is. And the money is there from the Biden administration for the, for doing stuff, certainly in the short run. And so, you've just put up some of the solutions, which is you lower class size. That's one of the ways that you meet the needs of kids, particularly post-pandemic, if we want to accelerate learning. Paperwork is a huge issue. We spend more time actually answering the data demands of states and localities and the federal government instead of actually focusing on teaching. The standardized tests they've never changed. There's a different, what kids need to know and be able to do is different today than it was 20 or 30 years ago. Let's align our accountability system with what we know we need to do. And because of the hot market, we have to have salaries where teachers, salaries that are competitive. So it's, these are the things that you need to do. And, some districts are doing them. And the places that are not doing them, like in Florida, where the governor is just basically demonizing teachers, that's where you have the largest shortages.
Randy, really quickly, another new school year means we're talking about new potential COVID guidelines for schools. Vaccines not necessarily required for students, even though all students are now eligible in terms of the age group. Questions about whether masks will be required, social distancing will be squeezed up a little bit more. What are you hearing from teachers? Are they prepared for this next stage where there aren't as stringent requirements in place?
Look, we're big believers that this is not a year to impose additional mandates. We have a lot of treatment options and mitigation strategies that have worked. You see that in terms of how, even though COVID's still around and still, serious, it is far less serious than it was before. And so we're a big believer that we should be focusing on what kids need in terms of the basics: reading, science, math, having extracurricular activities, making sure that these mitigations like, masking and testing and vaccines are really available, making sure there's no stigma to somebody who needs to or wants to wear a mask. But right now, let's focus on the academics and spend our time really meeting the needs of kids, including lowering class size, dealing with the teacher shortage, making sure we have the good ventilation and the emotional, social supports that kids need.
Yeah, probably something a lot of people can agree on. Randy, always good to have you on. American Federation of Teachers President Randy Weingarten joining us today.
Investors are still digesting a key read on inflation out this morning, with the consumer price index showing an increase of 8.5%. For more on this and the broader investing landscape, let's turn now to Scott Kroner, Citigroup Managing Director. Scott, great to see you here this morning. I really enjoyed your note on investing themes. I talked about it early in the week, but I want to get your instant reaction to the CPI report. Markets seem to love this. Are they right or are they wrong?
Well, I think they're right. I think there's been a lot of angst regarding the peaking in sort of Fed hawkishness, and I think what this sets up for is a little bit more appropriate Fed response to what we're seeing in terms of economic activity. So if you look at the Fed funds futures, for example, this expectation for Fed funds peaking in the beginning of 2023, it's an important narrative in terms of how we think about equity market positioning. So I'd say, yes, the response here is spot on for this particular data point.
In your view, was the June low the low?
In our view, the June low was the June low. We think at that point we were close to pricing in a mild recession. And so anything regarding interest rates or earnings that would be an upside to that mild recession risk were net positive for the market. Ergo, we had a positive view towards the second half for the S&P, which is sort of playing out pretty quickly here.
What type of basis point hike does this give the Fed credence to do at their next meeting?
Well, the discussion had always been around 50 to 70, and then 100 had crept in. I think this probably takes it back down to the 50 to 70. 75 basis point discussion. Somewhere in there we'll see, because we still have some economic data between now and then. But I think suffice it to say, the Fed still has to keep an eye on getting this inflation situation down to a point where it can probably step back and take a look at how the economic activity indicators fall from here. And I think that's still on the come.
We saw the jobs report last week, pretty strong. This report, encouraging. Are we just not going into a recession?
So there's a discussion out there that the soft landing scenario can take hold here, and that's part of our math in terms of how we think our S&P targets. I'd say there's probably still a decent chance of that. To get there, though, the way this has to play out is what's happening in the broader economy isn't precisely aligned with what's happening in the stock market per se, sort of a function of the construction of the S&P 500.
So the market has a price in a soft landing.
I don't think, the market is not priced in a soft landing. You can think of S&P levels more in the 4,700 level to reflect that.
So Brian referred to the thematic investing note that you put out. So if you're looking at a soft landing scenario, what groups then, what themes become the most attractive?
So let's step back on this, okay? So our view had been going into the second half, S&P 4,200 is a year-end target. We're nearly there. With today's action, we might be very close. That doesn't mean you exit the stock market. What it means is that you have to begin to move away from an index focus around traditional macro variables to, let's call it, much more of a bottom-up focus. And what the thematic approach does is begin to identify longer-term structural approaches to investing in the market that can help you navigate soft landing or mild recession, essentially a path to look across an economic valley to the other side. So what we're doing with this thematic approach is another means of leaning into the growth side of the market. The types of themes that are coming up in our work would include everything from artificial intelligence, internet-based business models, net zero, emerging market consumer, and top brands, which is sort of a moat play, if you will. But all of these align with approaches to stock selection that have more of a structural growth bias. That is our means of navigating this ongoing Fed-on, Fed-off economic recession or not situation in the broader markets.
And so across any theme right now, it still comes with this caveat that you could have companies come out and continue to provide guidance that is lower than what the street may expect in the near term. And so as we're seeing, even not just throughout the rest of this year, but even going into early next year, some of that guidance start to come in and then forecasts and outlooks, what would you be looking for specifically to say that we've actually turned a corner?
Right. So you start looking for, obviously, for negative guidance or bad news to elicit a positive market response. And that's sort of an ongoing, approach that we use. What I just want to emphasize here is that when you look at the first half of the year, the major multiple compression on the initial inflection in rates was on the growth side of the market, which is going to align with a lot of these themes that we're talking about. So our view all along has been that the rate effect on multiples has been mostly priced in, and going back to that June low discussion. And so from here, the issue does become, in our view, more of earnings growth trajectories. So you're right, you can still have a thematic play that succumbs to near-term economic response. Got it, that's to be expected. But still, what you get is some comfort that the underlying growth trajectory on a longer-term basis that comes with said company or theme is a means of navigating that near-term volatility around economic consequences.
So when you talk to your various analysts on the team, are there certain stocks that continue to pop up in their work that they like based on some of these themes?
Unfortunately, I can't talk to specific stocks, but the fact is, when you look at the S&P 500, and this was what was sort of interesting about the note, we have 91 themes that our Citi theme machine follows. And not all companies within the S&P 500 are allocated to these themes. So you have a lot of companies within the S&P that don't fall in this thematic approach. When we look at the performance of the stocks that are in the S&P that are in themes versus those that are not, they've tended to outperform over the past 3 years. Now again, past 3 years has had a growth stock bias to it, so it's not a big surprise, but it still plays to the same discussion. Essentially, you're looking for longer-term growth opportunities in a market that's still reconciling where we are with interest rates and economic activity.
Well, good to see you in studio for a change. We're avid readers of your work. Scott Kroner, Citi Managing Director, good to see you.
My pleasure. Thank you.
Welcome back, everyone. As the world deals with an economic slowdown, the demand for travel has remained relatively high as European booking company Trivago says they are positioned and prepared to serve travelers in this new environment. Joining us now, we've got the CEO of Trivago, Axel Hefer. Axel, always a pleasure to get some of your insights from the business, and thanks for joining us here today. First and foremost, what are you seeing in the travel demand right now? We know so much of the spending from consumers have shifted from goods and into services, but this is for the summer time period. Do you see that sustaining?
Yeah, I mean, we clearly see a very, very strong summer, that's for sure. And you can see that a lot of people have actually saved the money during the pandemic, and also we're looking forward to the summer trip. On the other hand, you also see that there's a fundamental imbalance in quite a few sectors in travel. So You have labor shortages in a lot of the areas, in transportation in particular, but also in the hotels as such. And there's a lot of demand, so that will have to balance over time.
What are you seeing in corporate travel right now specifically? Because we had seen some warnings, and there was a report from Wall Street Journal even about how Microsoft, one of the largest tech companies in the world, of course, is going to be looking across where they're cutting or monitoring travel spends. And there's kind of this need to go basis that might come into play for many companies. And so that's where the margins typically come in from. For Trivago, where would you see that start to show up in the business, and what adjustments would need to be made?
And business is a very small segment for us. I mean, we are helping travelers to compare prices and save money. And unfortunately, a lot of the business travelers are just booking with their corporate travel agency. So, but I do agree. I mean, the economic outlook is deteriorating, and in times like that, it is very likely that companies will keep their costs and optimize their costs and reduce non-necessary travel.
Axel, it's Julie here. You all have a price comparison tool, and I'm just curious if you've seen a big uptick in demand for that, and whether people are able to find lower prices right now with, as you alluded to, all of the price gains we've seen across travel.
Yeah, so I mean, we've seen some. What we've seen this summer, for example, I mean, we are running a TV campaign pretty much everywhere in the Northern Hemisphere, in Europe and in the US. And the message of that campaign is very clearly, we compare hotel prices for the same room and help you to save money, and it's performing very, very well, which is for us an early indicator of the behavior that we are expecting to see over the next 6 to 12 months, because prices will go up. Yeah? So the factor costs will go up, and hotels and airlines and airports will have to increase salaries to actually staff up their teams, which will then also ultimately be passed on to the traveler. So we think that our service is actually extremely relevant and more relevant than it has been to the traveler in the last 5 to 10 years.
So just to make sure I understand you correctly, Axel, we just had, for example, here in the United States, a consumer price index number today that showed a little bit of moderation in gains across the board of prices. It sounds like what you're saying for travel, we are definitely not near any kind of trough or slowdown in the price increases that we have seen because of the strong dynamics.
I think that the cost will continue to go up. And so because you see, and it depends a bit where you are, whether you're in the US or in certain European markets, and what exactly you offer, but you see a fundamental shortage of people in travel and hospitality. And the reason is that a lot of companies actually reduced their staffing during the pandemic and are now struggling in very tight labor markets to staff up again. And so they will have to pay up, and that cost will be passed on. Whether that is net positive or net negative, given the current squeeze that you see in certain destinations, that is difficult to say. But generally speaking, we think that prices will go up.
This is also a business that has a heavy deal of advertising spend that you have to account for as well. And at a time where we do know that many companies might be pulling back on advertising, perhaps some of the travel, leisure, experiential economy companies can't afford to pull back on that. And so what are you monitoring? What are you seeing there?
I mean, right now, everybody is basically keen on seeing the recovery and basically capturing the attention of the traveler. Now in the trips that everybody was looking forward to. I think it's likely that there will be some softness going forward, but it will be very unevenly distributed. So, for example, if you're hit by energy cost increases and your disposable income is coming down, you will still want to go for a trip. So you will compare prices more, and you might save on transportation and allocate a bigger portion of your budget to the accommodation, which you can't save on.
Axel, thanks for being here. Axel Hafer is Trivago CEO. Thanks so much for the time today. Appreciate it.
It is, to say the least, a weird time in this economy. The labor market's good, people are employed, but inflation is high. And there's no doubt Americans are feeling it. So how do headlines like this that you're seeing on your screen impact the psychology of the consumer in this weird economy? And how could that feed into the recessionary dynamics? Let's bring in UC Berkeley Haas School of Business professor Barry Schwartz for this conversation. Professor, it's great to have you on because I feel like we need to take a big step back here and just acknowledge the role that the way that people think factors into the actual economic happenings that we're experiencing. What do you see as kind of the big play here in how the way that Americans are thinking and consuming factors into the immediate issue of high inflation?
Well, let me just say amen to your sentiment. When economic uncertainty happens, people always go to economists to try to explain what's going on. And economists have a lot to offer. But I think the really significant impact of things like inflation or recession is not in the short-term problems with supplies that might spark it. It's not that gas prices go up for a few weeks because of some political intrigue going on somewhere in the world. What really matters is whether they persist. And whether they persist depends not on this immediate shortage, but on what people think this immediate shortage predicts about the future. Our decisions about whether to spend or save, whether to loosen our belts or tighten our belts, are all based on our predictions about what tomorrow's going to be. And that is really in the realm of psychology. Do I think that hard times are coming? Well, if so, I'm going to cancel my vacation. I'm going to cancel my work project, updating my home and stuff like that. Do I think this is a temporary problem? Well, then I'll go on my vacation and I will get the workman in to give me a new patio.
So then when we just had a chart up there showing how consumers are feeling versus how they're spending. So is that about confidence in the future, or is this sort of spending, comfort spending to make yourself feel better?
Well, there's a little of both. People may be very nervous about the future, but so down for whatever reason that they feel it's almost like they need to take another hit of a drug. Even though they know it's foolish, they do it because I feel so bad. Maybe this will make me feel a little bit better. But that's a short-term thing. The long-term thing, making strategic decisions about whether and when and how you're going to spend your money, is really about whether you think the current economic conditions are going to persist. Robert Shiller, Nobel Prize-winning economist, has said that if there's a recession, it will almost be self-fulfilling. It'll be the result of our talking ourselves into a recession. There was an op-ed in the New York Times last week by Kyla Scanlon, and she said, quote, "The root of economic problems lies with expectations." And that's the realm of psychology. And I got to say, this has always been true, but prior to the 24-hour news cycle, you just didn't get bombarded over and over and over again with economic news, trivial changes from 1 hour to the next. Now we're just assaulted with it in the same way that when we're driving around town, we keep seeing these signs for the price of gas and we can't avoid it. Well, now you can't avoid people predicting that prices are going to go up or, jobs are going to go down or what have you. And it just starts to infect you. And lead you to have either optimistic or pessimistic predictions about what tomorrow is going to be like.
And Professor, you talk about the 24-hour news cycle, right? I mean, people might be listening to our conversation and forming those views, but it also depends on what policymakers are saying as well. And we heard President Biden trying to take a bit of a victory lap over the July inflation numbers yesterday. Take a listen.
I want to say a word about the news that came out today relative to the economy. Actually, I just want to say a number. 0. Today, we received news that our economy had 0% inflation in the month of July. 0%.
But then you had economists like San Francisco Fed President Mary Daly, who has the ability to lever interest rates, saying in a new interview, quote, "Consumers and businesses are getting some relief, but inflation remains far too high and not near our price stability goal. This is why we don't want to declare victory on inflation coming down. We're not near done yet." Does this add to the confusion that Americans feel when they're getting these types of commentary out there?
Surely it does. But I got to say, confusion is better than simply being wrong. You know, it's being wrong about the future that leads people to go out in their lunch hour and buy groceries, because by the time the workday is over, the price of groceries is going to be up 5%. If we're uncertain about the future, it's not going to lead to a kind of systematic explosion of expectations about what prices are going to be like in the future. So if we just don't know what prices are going to be like in the future, chances are pretty good that we'll behave tomorrow the same way we behave today and curse all of these people that we're watching because they're not all speaking out of the same side of their mouth. And I got to say, with respect to Biden's comment, I think this is an effort to try to diffuse the incessant talk about inflation or recession, so that the sort of expectation-driven worsening of those conditions can, to some degree, be dampened. There isn't zero inflation. He knew there wasn't zero inflation. He was just trying to tell people, listen, don't listen to all these hysterics on 24-hour news telling you how bad our economic future is. It's not bad.
So then, so as we look at this then, you're trying to keep a level head, taking in this information. What should people do to really so that they can get a real clear view of how they should be viewing the economy without sort of panicking at every sort of bit of news data that comes out?
I wish I knew how to answer that question. You know, there's a joke among non-economists and some economists that the economic profession has predicted 9 of the last 3 recessions. So everybody would like to know the secret of what tomorrow is going to be like, but nobody knows the answer to that question. So all I can say is to take all that you're hearing with a grain of salt. You know, many people, you know, most of the money they spend, they need to spend. They spend on necessities. But there are a lot of people in a privileged position where a significant amount of their spending is discretionary. And so it seems to me, if you're a little bit uncertain about the future, you pull in your belt a little bit for a month. It's not the end of the world to defer some of these discretionary expenditures. Get your new washer and dryer in October instead of getting it tomorrow. And as things settle out, you'll come to a view about how stable the economic future is and in what direction it's moving. And then you can start pulling the trigger. But, you know, you can't find certainty. And I think confusion is better. It is better to be confused than it is to believe the wrong thing.
Well, we're going to leave that there. That's an interesting mantra to end on. Thank you for joining us, Barry Schwartz, UC Berkeley Haas School of Business professor. Thank you for joining us this afternoon.
Thanks for having me.
Welcome back, everyone. We've seen the markets in rally mode over the last few weeks as the latest economic data shows signs inflation might be cooling, but our first guest this morning says we're not out of the woods just yet. For more, we bring in Amanda Agati, who is the PNC Asset Management Group Chief Investment Officer. Amanda, great to have you here with us this morning. All right, help us break this down and your perspective here, why we're not out of the woods just yet.
Well, it's always nice to be with you. Thanks for having me, and good morning. I would just simply say that one data point does not make a trend by any means. And so the market really took the July CPI report as claiming victory, that the peak is officially in. And while that might very well be the case, the market has rallied an awful lot, assuming that the Fed's forward guidance and ultimately the terminal rate assigned by the current dot plot is really where policy is going to ultimately end. And so I think we need a bit more in terms of data points to confirm that officially the peak is in. I think over the next couple of months, we can certainly get confirmation of that to the extent that CPI continues to move in the right direction. But we don't have confirmation from the Fed and Fed governors across the board that really the guidance that they have laid out is really it. I think the Fed is very much fixated on needing to do more, and that's a very vague term. And so the key question is how much more aggressive, how much more hawkish from here. If they go much more hawkishly than what the market has already priced in, I think that does create some downside risk given where valuations are sitting today.
Do you think we're overdue for a little bit of a pullback here?
I think it's possible, sure. The market really wants to move higher. You can tell by the psyche, certainly, of the market here over the last few weeks that it's just fixated on trying to get past a lot of the macro challenges and the concern around Fed guidance and just grind higher here. But I think over the balance of the summer, the high volatility regime is just going to continue to dominate. I think things are going to continue to be quite choppy until we get further confirmation of inflation peaking or rolling over and some stability in terms of that Fed forward guidance. It kind of all comes back to those two key variables.
Okay.
So I think it is possible to see a little bit of a pullback here.
So what would you think that the likelihood would be for what you've talked about as a perhaps Christmas wish for a Fed pause?
Well, it's no longer July, but I'm going to stick with my corny joke that my Christmas wish or Christmas in July for me certainly would be a Fed pause coming in December. The market's actually assuming a little bit over a 60% chance of a zero policy rate move in December, aka a Fed pause. And so for me, I'm still trying to figure out whether my Christmas wish is going to be granted or I'm going to end up with coal in my stocking. But I think if we got that Fed pause, that would be really positive in terms of a catalyst to get this market rally re-engaged and set the stage for a much more positive 2023. So that's where we're focused. I think it's less at the moment about individual rate hikes between now and the end of the year, and much more about where that terminal rate is going to land and whether or not we get that Fed pause. It doesn't matter from the market's perspective whether we get 50 basis points in September or 75. At the end of the day, the destination, that final destination, is kind of where the market has priced for. I think that's really good support for the market at these levels.
Man, and my Christmas gift, early Christmas gift, is a couple of some tequila I'll be having at happy hour tonight. I'm very excited about that. But look, you mentioned volatility in the markets. We're just seeing a lot of just wild swings, notably for companies that are losing money. What is triggering this?
Well, the high volatility regime has been absolutely a hallmark of this entire cycle since the onset of the pandemic. I keep saying hashtag high volatility regime, and everybody I talk to is like, when are you going to retire that hashtag? But I think, unfortunately, this dynamic is still going to be with us well through the end of this year into 2023. And I think it's much more a function of this market really struggling to assign value or price the perfect storm of macro headwinds that are swirling. And so when you see the companies that are really challenged from a fundamental perspective, those non-earners really see a lot of whipsawing here. I think it's a function of what is the backdrop ultimately going to be, and is it going to be supportive for the companies that are struggling the most here? Are we going to end up with financial conditions in overly restrictive territory? We're not there yet, but I think the market is really struggling to price value and assign value in this kind of a fuzzy perfect storm backdrop we have here.
How do you imagine that U.S. companies might continue to see growth challenges considering their annexation to or their reliance on revenues that may come in from EU countries as well, which are already trying to weather their own set of economic uncertainty?
It's something that we're watching very, very closely, but I would say just in general, U.S.-based companies, even though they may be multinational companies, are absolutely the best position and best on the global block, if you will. And so we think that U.S. Domestic equities, U.S. exposures are going to be very well positioned to the extent that growth continues to slow. On a relative basis, we think we're in better shape. That is, corporate America has more room or margin for error, if you will, from a profitability perspective to kind of weather this storm here. So definitely focused on the challenges in the EU. We don't see, a meaningful reversing of course there and a snapback in terms of underlying fundamentals. But I think other parts of the global economy are really seeing some meaningful signs of strength, and I think that's enough to keep them powering through.
Keep those investing hashtags coming, Amanda. I like them. Tweet them at me. I really enjoy it. Amanda Gotti, PNC Asset Management Group Chief Investment Officer. Have a great weekend.